Hi, I'm Peter Rose, founder of Longwood Currency Trading. When it goes bad, it can go really bad. That's the kind of the thrust of the video I want to do today. And the reason that I want to chat about this is not only what's going on with me currently in the Forex market and my trading, but also some weather calamities that we've had here in the Lakes region in New Hampshire that are they're the same thing. When things go bad, they can go really bad. Okay, so part of the story has to do with this weather thing. Those of you that watch my channel know that I have a brook over there, and as you can see, the whole yard is flooded. We now have waterfront property from some really severe storms that we had yesterday. 60-mile-an-hour winds and gusts, and got about 6 inches of rain up here on the mountain and in this general area. So there's been a lot of flooding. There's roads that have been washed out. So it wasn't just a rain, it was a rain. And now about some trading. All right, so even though it's mid-December of 2023, the temperatures were up around 40 degrees or so, 45 yesterday and the day before, because we started raining the day before that. And so even though it's December, it's 40 degrees, but it's still chilly out for sure. The storm was so bad that one of the power transformers across the road from us blew up. Woke up at 5 o'clock in the morning to this fireball. 3 of them actually. It took 3 of them to take the transformer out. In any event, what's that got to do with trading? Well, don't you find that there are periods that you just can't get it right, that nothing is jiving for you? Part of that is a statistical probability. If you're trading fairly actively in the market, if you're going to do like 300 trades a year or something like that, then the chances within that time frame, or within 100 trades that you make, that you'll have 6 losing trades in a row. You're also having the capability of having 6 winning trades in a row, but because some of the times, most of the time, every time, we tend to cut our winners short and let the losers run. That's where the catastrophic, when it gets bad, it gets really bad, comes into play. Because we have our psychology that plays against us, right? I mean, you lose a couple and you go, oh, shit, blah, 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 and then you roll the dice and you go in again, and that loss is double what you lost the first 2 times, and you just can't figure it out. Now you're revenge trading and you're looking for trades and doing anticipatory trades. It gets really bad. So now you couple that with, for example, we're in December, which at the end of the year, all of the stock markets are winding down. The investment banks, the hedge funds are realigning themselves. The retail investors are trying to get their things in order so that when the year ends, they're in the best tax situation that they can be in. There are all of these factors, if you're looking at the financial markets, of which the currency market is the largest by far. It dwarfs all of them, all the rest of them combined, at pretty close to $7 trillion a day of market volume. But not only have you the normal December scramble for the exits in all the financial markets, but in this particular year, we've had, a year ago we were started coming out of a pandemic. We've had an inflationary period in the United States here and throughout the world, where interest rates have been risen by the central banking authorities in almost every country to combat inflation. In the United States, there were 14 or 15 interest rate decision rises trying to bring the inflation rates down. It's been catastrophic for the economies of all the different countries. The real estate market has gone into a big expansion, and the commercial market has collapsed, and they're scrambling around trying to so that there's chaos, normal chaos, and then there's additional shitstorm stuff that goes on, which again, statistically, you're going to run into this confluence of events that creates a big thing. That's where rogue waves come from, right? 1 out of 437 is 8 times the mean height or something like that. I forget what the statistics are. Or in the movie The Perfect Storm, if you've seen that movie, wonderful movie, about the 3 storm fronts coming together and forming this monster of a storm. So that's what we have in this December. And I've been very careful trading that. I've been some days I trade very small. I trade just one time maybe. I've done really well so far in December. I'm up, I think, $12,000 or something for the month. And trading a 6-figure account. So I'm running about, on the average size of my trades, I don't trade 15, 20 lots every time, particularly in an environment like this. A lot of times it'll be a 3 lot or an 8 lot or something like that. So on average, I'm up about 7% for the month. That's where I'm heading right now, as long as I don't take, for right now I'm running a $2,000 loss on my trading in a running trade. I've got it running. I don't care. I'm just going to let it go because I've already got out of half of the position. And so I'm waiting to see if there's going to be a retracement to that price. So when I get done with this video, I'm going to go back and look at it again. And if it's gone completely bananas against me, I'll probably have to close that out. I made $3,300 yesterday, so I may lose that today. Oh man. When you get, and I may very well be into a statistical period where my hit rate isn't too well. Generally speaking, I'm running between 80 and 90% positive days when I trade. Now, I don't trade every day, the 20 days in the month. I may not trade every day. I might not trade for the 20 days. Let's say I trade 10 days. Well, of those 10 days, 8 or 9 of them will be positive trades. So I end the day positive. But my win-to-loss ratio, which is on a transaction basis, if I look at my ability to trade on a win-to-loss ratio basis, it was about 70-30%, something like that, on a transaction basis. When I'm staging and I'm probing the market like I do now, that win-to-loss ratio is probably down around 65%, 63% win. Simply because when you have these chaotic markets, you need to probe in order to have the opportunity reveal itself. You can't wait the way you normally would for an opportunity to happen, because you're not going to get that many pips. When you have chaotic behavior, it's like music. There's a theme to that music until you get to this dissonant stuff, and then you have all these instrument things go crazy, and you have to really look very hard for the thematic parts of that dissonance. And in trading, because trading goes in waves, you have trends and then you reverse the trends, or maybe it's a pullback and then you reversing. So they're like mathematical sine waves, deformed sine waves. We look at them. In fact, that's how we model our systems. Those of us that are technical and write computer simulation programs can model a price action based on wave theory. In any event, when you run into chaotic periods, all that gets screwed up, and your metrics that you rely on get kind of screwed up. Particularly when you're trading multiple lots, because then the metrics that you traded before, which defined your trading ability in an all-in, all-out situation, are not valid in reverse staging, multi-lot staging, probing analysis, and stuff like that. For example, if I'm all-in, all-out trader and I just stay with that over long periods of time, my win-to-loss ratio was 70-30. And as I've said now, when we're dealing with multi-lots and reverse staging and all that other kind of stuff, we have, or I have, dropped that down into the 60s. Still, a 60-40 trader can be very, very profitable, but you have to trade a lot in order to do that. As a 70-30 trader, you don't have to trade a lot in order to make the equivalent, if not more, from a dollar standpoint. Those are some of the theories that I go over with in my coursework with people to make them understand that all of this is a probability event. It's a game. And you treat it as game theory with all the psychology thrown in to that market, with rules that deal with both the psychological aspect of the market that you're trading plus the probabilistic nature of that from a theoretical standpoint. In any event, I made $3,300 yesterday. I may lose, well, I'm already down 2,000 open run right now from that. I don't know what it's going to be now, so I don't know how the day is going to come out. I may flip that around and be able to make a couple of $1,000 net, or I may end up losing $3,000 or $4,000. The day before I made, I don't know, $2,400, and the day before that I lost $1,400. So my daily value of winning days to losing days is now probably around 75% winning days, and the other days losing. I'm positive because I know how to trade. So even though I might lose $3,000 or $4,000 today, I've made $3,000 and $1,400 and blah 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 blah. And so I may take my monthly gain. By the time we wash this thing out, my monthly gain could be anywhere from 7, which is it's right now at 7%. So I could end up at 4 to maybe 10%. I'm not real sure that I'm going to hit that 10% return against risk, because there's only a few trading days left. We're halfway through the month here, and we've got the holidays coming up and the prep for the new year, and everybody else winding down, and so the markets will change, but they'll still retain this chaotic basis. You can still generally trade during December. You have to be very careful, but you add to it all this chaos, you have to be very, very careful. And so when you're trading with some heat like I do, and you drop 10 or 15 pips on a stop, entry stop, well, that's a couple of $1,000 maybe. So even though the pip value remains about the same, you're following you're not losing as many pips on the entry. You're trading with more you're trading with more lots, and so you lose more money. So there is a balance that you need to be able to adjust to between what theoretically you should be able to do. Oh, I'm a 60-40 trader, blah, 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 and I have daily wins of, 60%, 70%. All that shit goes out the window. It's only an indication of how well you do when you're not into statistical anomalies well, they're not anomalies, they're statistical periods that you're going to go through. So you're going to run to 6 losers in a row. And if you revenge trade and you let those losers run, you could wipe out your whole month, if not your whole account, in those six trades. I've done that. I mean, come on. You don't eliminate these large drawdowns and losses because you're experienced. You take horrendous losses because you're trading not to pay the light bill, but you're trading to make job replacement income. If you're trying to make job replacement income, you have to be willing to risk your job income. I mean, that's just game theory. That's just the way things are. You don't go into a poker game saying, oh, well, I've brought $1,000 to the game and I expect to wipe everybody else out and come away with $5,000. You might if you're really, really good or the gods are with you, but chances are you'll make 10, 15% on your money, 20% on your money. You do that 4 times a week, you're doing really good playing poker. The problem is when you hit those statistical losing periods, your $1,000 is gone. You reach into your pocket, you drop another $1,000 on the table, that goes, you reach in your pocket, pull another $1,000, and that goes, you go to another game another night, and the same thing happens, and pretty soon your bank is in serious jeopardy. Game theory is the same whether you're playing poker, whether you're trading stocks, not so much if you're investing, but if you're trading, then it becomes game theory. If it's not trading, then it's investment theory, and then you read Graham and Dodd and do it like Warren Buffett. But you don't, you make, I mean, the greatest hedge funds and brokers and whoever is managing your money, the best of them, you're lucky to get 12% a year out of that. Now, of course, they're making 14 or 15 because they're scraping 2 off the top as their VIG. But when we're looking in the currency markets as making 20, 40, 60, 80, 100% a year on our money, you can't expect on a monthly basis that you're not going to take a big whack against your bank. So when it goes wrong, you have to begin to understand, is this a statistical problem? Is it a problem of a chaotic market? Is it a period of economic change and readjustment in that market? Now, you don't change your trading methodology if it goes from a chaotic market to a trending market to a chop to a... If you know how to trade, you trade. You don't trade a system. You don't say, oh, I can't trade my trend following system now because I'm in a chop. Well, but you just trade. I mean, it makes me crazy that there are so many currency traders that are trading, because you can't invest in currencies. The big institutional banks can. They have whole floors of brokers that all they do is buy currency, so they stockpile it, so when they need it, they've got it to sell. We don't do that as retail traders. We're trading to make money. If you think you're gonna go in and trade the daily charts and make 300 or 400 pips, well, over what time frame are you going to do that? How long is it going to take you to get 300 or 400 pips on a daily chart basis without having a 60 pip reversal of price, when the ATR of the bar is on the majors is 80 to 120 pips? It's ludicrous. It's crazy. And even if you do make 300 pips, over what time frame did you do that? 2 months, in order to withstand all that stuff? Well, I mean, we've had periods where we've had, I don't know, 15-minute candles go 80 pips, 100 pips. I've documented them on this channel. I've shown screenshots of it. And so you can't say, well, it'll take 3 months, it'll take 6 months to make 300 pips. You can do it in a day. 3 ATR. You can do it in a day. But in normal market conditions, when you're trading and following these trends or whatever, you're not going to do that in 1 or 2 days. It'll take you a couple of months. So you make 300 pips in 2 months. If I'm day trading and I'm knocking down 10 or 15 pips a day times 40 days, I've made a hell of a lot more than the 300 pips that the trader is going to do. In that process, I might have lost a couple of hundred pips as well. But I break out on the top side of being above. Well, that's just my opinion of it. The long-term traders look at us that are doing the day trading and the shorter-term time trading as crazy and risky and all that other stuff. And it is for someone who thinks as an investor. I mean, a house flipper doesn't think the way that I used to think as a real estate investor. I held properties for 20 years. So I would look at a flipper and say, well, you're crazy. You're investing $300,000 to in this flip to turn this around in 6 months and hopefully make $80,000 or $60,000. Well, that's great if you can do that successfully 3 or 4 times. But what happens when you lose, when you get that flip wrong and you lose the $300,000? Or you have to hold that house because of problems, and then your $50,000 gain that you're looking to get is absorbed in the real estate taxes and carrying costs and mortgages and all the rest of the crap that goes with holding a house. These are probabilistic calculations that you have to be really comfortable with in making, and it's something that's really simple to do if you have the right person showing you how to work your way through all of that. But all I'm here to say and to confirm for you is that when things go bad, they can go really, really, really bad. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.